I'm Derek Pesta with Pesta and Pesta Wealth Management. For over 5 decades now, we've been working with clients and families in the tech industry that have built significant wealth. And most of those families come to us feeling overwhelmed even after working with other advisors. In this video, I'll walk you through the exact framework we use to help our clients maximize their RSU benefits for those with $3 million or more in liquid net worth while juggling taxes and other long-term planning items. I'll explain the 3 phases of our 90-day process, and in the 3rd phase, I'll explain why most approaches fall short. The first thing we do is map your RSUs to reality. When we look at your RSUs, we want to be aware of what your current income is, for example, from your base salary at work. We also want to be aware of any liquidity events that may be coming up. Liquidity events just means things like, do we need cash to buy a new home? Do we need cash as a down payment for a new home, for example? Maybe we're looking for cash to pay for the kids' school. These are liquidity events. Another thing we want to make sure that we have a good grasp on is what is the vesting schedule of your company and how many RSUs or dollar amounts in RSUs are we looking to get per year. And what we do is we look at the vesting schedule so we can understand how this maps out. And then we tie that to your tax return, because the RSUs may look great on paper, but we need to make sure that we have a good understanding of how this impacts your tax return. Another thing we want to do is look out and make sure that you're withholding enough from each paycheck to encompass the amount that's going to be hit from your RSUs. One thing that's important to remember too is that most companies only withhold around 22% for income tax purposes when your RSUs vest, but your income tax rate might be much higher, maybe even 37%. So it's important to make sure that we're doing a good job in making sure that we're sending in estimated tax payments if needed to make sure that you're not on the hook for any unintended tax consequences, penalties, or interest. Let's say, for example, you're in your late 20s or early 30s and you're looking to buy your first home. And let's say, for example, your first home is in the Bay Area, it's gonna be for around $3 million. And if you're gonna spend around 20% as that down payment, you're gonna need around $600,000 in cash. So let's assume that your base salary is about $200,000 and you have another $200,000 in RSUs that vest on a semi-annual basis or every 6 months. What that means is that every 6 months you should have around $100,000 in RSUs that are going to be vesting, and we want to make sure that we're doing a good job in planning for your liquidity event, the event in that you need that cash to be able to put down as a down payment. So let's pretend that you have $400,000 already saved, so you really only need a year's worth of RSUs vesting in order to get that extra $200,000 in cash. Next, in phase 2, we map out when to sell or hold the RSUs for each family that we're working with. Sometimes it may make sense to continue to hold on to those RSUs and allow them to grow. In other instances, it may make more sense to just go ahead and exercise and sell those RSUs after each vest so that you can build up a cash reserve for those upcoming goals. We really want to be careful about when we decide to exercise and sell or just continue to hold on to these RSUs, because not being mindful can have unintended tax consequences, such as affecting your Roth conversions in future years. It can also affect strategies around charitable giving, and furthermore, it can bump you up into increasing tax brackets if, for example, you all of a sudden decide to sell and exercise a bunch of RSUs to help come up with that cash needed for a home renovation or to pay cash for a home. So when looking at phase 2, we're really working with our clients in order to make sure we're doing a good job in advising them on when to exercise and sell and on which tranches to just hold and let them grow long term. Finally, phase 3, reallocate your RSUs tax efficiently within your long-term plan. Imagine being able to relieve yourself of the tax headache of your RSUs, because they really are a great thing. And when you do your tax return, it's actually a good process, knowing that you made smart decisions. So what we do to help our clients is, number one, make sure that we're helping minimize the capital gains taxes that can occur when they do hold on to their RSUs and allow them to grow, which many of our clients do as tech professionals here in Silicon Valley, whether they work at Apple or Nvidia or any of the other great companies here in Silicon Valley. One of the things that happens with a lot of our clients is that they let their RSUs continue to grow. And this has been a great thing. This has allowed their wealth to accumulate and build into extraordinary means. One of the things that we do to help our clients, though, is we start looking at ways to diversify these or use these positions in a more tax efficient way, such as looking at a long-short separately managed account. What these long-short separately managed accounts do is it allows our clients to either put that stock into this account in kind, not having to diversify any of it at all, or it allows them to put the stock in kind and diversify over time. The benefit for these clients is it allows them to continue to grow their wealth, but at the same time, it also produces some significant tax loss harvesting benefits that prepares them for in the future when they do need to sell to help minimize the associated tax impact of that. Another way that we help our clients navigate when to prepare for these events is combining the tax-aware long-short strategy with a tax-aware hedge fund. And by being able to combine these two together, we've seen the results from our clients over the past couple of years. We've seen how much better their tax situation has been and coordinating that with their tax professional. Imagine you, yourself, and your family having the same type of relief, knowing how the plan is going to work, knowing that your money is working harder for you, especially with how many hours you're putting in with that work, with all the sacrifices you're making and time that you are spending away from your family or on other things besides work. So that's what phase 3 is really all about. If you're earning equity and are unsure of when to sell, how much tax you're actually paying, and what to do with the proceeds after, that's exactly what this process is built for. At the end of the day, it's not about what you make, it's about what you keep. And if you'd like to explore whether this framework makes sense for you, book a call using the first link in the description below. Thanks for watching.